Today we will be covering Chapter 8, Portfolio Theory and Capital Asset Pricing Model. I will do this session in two separate sections. I will start with Portfolio Theory. In the next video, I will complete the Capital Asset Pricing Model. The risk-return trade-off plays an important role in corporate finance theory. Companies face variability in their projected cash flows. Investors also face variability in their capital gains and dividends. You can see that during this COVID-19 crisis, where stocks have fallen, investors have lost money, businesses are going out of business. Portfolio theory is a financial term denoting a collection of investments, a collection of financial assets such as stocks, bonds, cash, etc. So basically, if you hold 1,000 shares of one particular company, it cannot be known as a portfolio. It must be a collection of investments. If you hold 2 or more shares, it is considered a portfolio. Portfolios can be held by an individual investor and or managed by a professional manager, such as mutual funds, unit trusts, banks, other financial institutions. For you students, it would be better for it to be managed by mutual funds. If you scroll down the bottom, I've given you another explanation. A group of financial assets such as stocks, bonds, cash equivalents. It has to be a group of financial assets. Assuming that companies or shareholders are rational, the aim would be to minimize risks that they face for a given level of return they expect to receive. You need to have a firm understanding of the nature of the risks investors and companies face. Moving on, risk. Companies face risk from variability in projected cash flows. Variability means fluctuations. Businesses can experience a downturn or an upturn in the year. Investors also face risks from variability in capital gains and dividends. You have seen now in real life how COVID-19 has affected the share market. The aim is to minimize risks first for a given level of return. In order to control risks, it has to be understood and be able to be measured. I put here, it must be able to be quantified. And because it can be quantified, you are able to manage it. Next slide. How do you measure risks? Risks can be measured by standard deviation of the returns of a share based on either historical returns or expected future returns. Please note that when risk is measured by standard deviation, we are actually measuring total risk of the company. I've given you an explanation here. Standard deviation measures the dispersion of data from its mean. The more the data is spread apart, the higher the difference is from the norm. Standard deviation is applied to the annual rate of return of an investment to measure its volatility. Volatility in this case stands for risk. Here, it is a measure of that is used to quantify the amount of variation or dispersion of a set of data values. If you look at the bottom of this slide, I've given you an explanation of how variations can exist. In the next slide, we are now measuring standard deviation. You notice here I have made a division between the left hand side and the right hand side. On the left hand side is how you measure it using probability. On the right hand side is how you measure it using historical data. In your assignment, we use historical data to measure standard deviation. If you remember, I asked you to calculate standard deviation for 2014, 2015 until 2019. So this is the formula that you have applied to calculate standard deviation. Moving on, this is a distribution of returns on S and Y. S and Y are basically two securities or shares. You will notice security S has a narrow distribution, whereas security T has a wide distribution. This implies that security T has a higher standard deviation. We move on to the concept of diversification. In this slide, it is stated total risk can be divided between systematic and unsystematic risks. Systematic risk is due to systematic factors such as changes in interest rates, business cycles, government policy. COVID-19 is an example of systematic risk, whereby it cannot be controlled. Everyone, countries, people will be affected by systematic risk. Unsystematic risk is specific to a given share. Therefore, it is diversifiable. It is also known as specific risk. An example of unsystematic risk is when a fire breaks out in a particular company. Not all companies are affected by the fire. Only that particular company is affected by the fire. Hence, it is known as unsystematic risk. You will notice in the last point, unsystematic risk decreases as the number of investments in a portfolio increases. This is known as portfolio diversification of risk. Hence, the more shares you have in your portfolio, the less unsystematic risk you carry. It is shown in the next slide here. This portion here is unsystematic risk, whereas this portion here is systematic risk. In order to diversify away unsystematic risk, an investor will need to invest in between 25 to 30 companies, thereby able to reduce unsystematic risk away. You notice this downward sloping line. The more shares you carry, the less unsystematic risk you carry. Whereas in this portion here, this is systematic risk. No matter what you do, no matter how you try to counter this risk, it cannot be diversified away. Examples of systematic risks are political events, war, interest rates, all of which it is uncontrollable. At the bottom of the slide, I put down here, diversification can help investors manage risks and reduce volatility of an asset's price movements. No matter how diversified your portfolio is, risk can never be eliminated completely. We move on to looking at the 2-share portfolio. This is exactly what you have done in your assignment. We start by talking about correlation coefficient. The amount of risk diversification depends on the correlation between returns and hence the value of the correlation coefficient. If you have a +1 correlation, you achieve no diversification of unsystematic risk. In other words, if one share goes up, the other share goes up as well. However, if you have a -1 correlation, you can achieve full diversification of unsystematic risks. In other words, when one share increases, the other share decreases. You can also achieve zero correlation, whereby no correlation exists between the returns of the 2 shares, and in this instance, only partial diversification of unsystematic risks will exist. The correlation coefficient is a statistical measure that indicates the extent to which 2 or more variables, in this case shares, fluctuate together. So the more you are negatively correlated, you will be able to achieve diversification of unsystematic risks. In this slide, I've also put it is a statistical measure of how 2 securities move in relation to one another. These are examples of positive, negative, and zero correlation. Hence, in order to calculate the portfolio return of a 2-share portfolio, as per your assignment, you need to calculate using this formula. Notice there are weights given to it. If you remember your assignment, I've asked you to calculate the return of the portfolio of 2 shares based on 10% intervals, 100, 90, 80, 70 onwards to 0. On the other share, it will be 0 up to 100. This is how you calculate the portfolio return. On the other hand, in order to calculate the standard deviation of your portfolio, which you have also done, this is the formula that you will apply. Again, it is based on weights. Notice here, these are weights of one particular portfolio. This is weights of another portfolio. At the end of the day, you are able to come up with this on the basis of two shares using the same example, share S and share Y. We determine that the mean return of S is 5.96, the mean return of T is 9.10. The standard deviation for S is 8.16, standard deviation for T is 13.39. The correlation coefficient between S and T is negative 0.389. On the basis of the returns and of T and S, we are able to draw the graph using intervals of 20%. You notice 80% for S and 20% for T. I've given you the calculation here, and on basis of this calculation, we're able to come up with this graph. So if you achieve a negative correlation, your graph should look like this, an umbrella shaped curve. Points S, A, B, C, D, and T are plotted using this. If you notice in the next slide, investors can choose portfolios anywhere along the arc SABCDT. The risk of the portfolios is less than that represented by the straight line S and T. You notice the risk is lesser, right? By combining S and T has reduced total risk by diversifying away unsystematic risks. Hence, as we increase the number of shares in the portfolio, we are able to obtain a bat wing shape, as shown in the next slide. Here, there is a 4-share portfolio, and this is the area where you can get a bat-shaped wing. We now move on to how investors' attitudes towards risk are. Okay. The attitude of an investor to different combinations of risk return is reflected by the shape of your utility curve, also known as indifference curves. These are the utility curves of a particular investor. On the x-axis, you have the risk measured by standard deviation. On the y-axis, you have the return. And if you notice, this is an upward increasing utility curve. As risk goes up, the return to be compensated must go up as well. The attitude of the investor to different combinations of risk and return is reflected by the shape of their utility curves. In the next slide, you will notice the two different investors, UO and VO. They are representing two different investors. The UO investor is a risk-loving investor, whereas the VO investor is a risk-averse investor. Risk-averse investors are investors who do not like risk. You notice that the VO investor, the risk-averse investor, the shape of the curve is steep, whereas the UO investor, the risk-loving investor, the curve is gentler. In the next slide, you will also notice this is U, the risk-averse investor, and this is the risk-loving investor. You notice the risk-loving investor, the curves are gentler, whereas the risk-averse investor, the curves are steeper, i.e., the more risk a risk-averse investor takes, the higher the compensation of returns the investor expects. We now move on to portfolio theory. This is a theoretical area, so please try to understand this area. I start by highlighting this point. The theory that holds that assets should be chosen on the basis of how they interact with one another rather than how they perform in isolation. An optimal combination would secure for the investor the highest possible return for a given level of risk. In this slide, rational investors invest only on the efficient frontier, thereby maximizing their utility. From this highlighted point, you can see the rational investor would only invest in the shaded area. The shaded area represents all attainable portfolios. I've given you an explanation here. Investors can construct portfolios anywhere in this shaded area by holding different combinations of available risky assets. The key term here is investors can only invest in risky assets. Risky assets would mean shares, bonds, mutual funds, and so on. Risky assets do not include risk-free assets. Point number 2, if risk-free assets are available, investors will combine them with the market portfolio. Come on.